Most restoration companies doing over $8 million a year of revenue are flying blind. Why? Because their books are lying to them. They're either on QuickBooks or they hopped on the PSA bandwagon and they have no financial visibility over what their business is doing. If your revenue has grown, but you can't rattle off key financial metrics such as contribution margin, gross margin, customer acquisition cost, and obviously net income, you literally don't have financial visibility and you can't know what levers to pull on to grow your business. A few years ago, I sat down with a restoration company doing $14 million of revenue, and they had thought that they were doing $4 million of net income or EBITDA. And when they went to go sell the business, they were expecting their business to be worth $32 million. By the time the financial audit came in place, it turns out that they had a lot of improperly recorded income via reconstruction deposits, and their EBITDA or net income was only about $1.5 million, and their business was only worth $12 million, not $32. That was a huge shock to the owner and the entire management team, and it actually blew the entire deal up. Now, whether you're building a business for legacy or you're building a business to eventually sell, these stories are not rare. They're actually very, very, very common. I see them over and over and over again. And every time, it's simply because the financial sophistication of the business did not keep up with the management and ownership rigor and grit that existed. So in this video, I want to break down 4 things. Number 1, I want to dive into the biggest accounting mistakes that $8 million plus restoration businesses do and how you can avoid them. Number 2, I want to identify why QuickBooks Online and QuickBooks Desktop, which is the most commonly used accounting system in the restoration industry, fails at scale. And I want to give you guys some bubblegum and duct tape solutions to try to help alleviate that pain. Number 3, I want to discuss the importance of ERPs and when you should consider switching over to them, ERPs such as NetSuite and Sage. And number 4, I want to give you guys the exact tech stack that I recommend for $8 million plus restoration contractors to use as they're scaling into the next phase of their business. So let's dive in. So there's 2 things that are literally wrong with most restoration companies that I see over and over and over again. And they're all linked to this concept of revenue recognition, or when they book revenue. And the first problem I see with restoration companies is that they operate off of cash basis P&Ls, meaning they recognize revenue when the money hits the bank, and they recognize costs when the money leaves the bank, and they recognize net income as actual cash net profit. And that's great when you're looking to file taxes, because when you're sub $15 to $20 million a year, your cash basis P&L is going to look very low, and you'll have a lot less taxes to pay than on an accrual-based P&L. So for tax purposes, it's not a bad thing to run your business on a cash basis and give those numbers to Uncle Sam. But the problem with cash basis accounting is it doesn't tell the full story of what's going on with your business. You could look cash poor, but the business could actually be doing very, very well simply because you're not collecting fast enough. So you constantly want to do this thing called accrual-based accounting, where you're recognizing income when you actually invoice projects. You're recognizing cost of goods sold when you actually incur bills from subcontractors, and you're recognizing expenses when you actually incur the bill or the invoice of that expense. And your net income is actually accrual net income or accrual EBITDA. A common example of where this is flawed is the following. Let's say you have a $100,000 restoration project that you're working on for Mrs. Jones's house, and it's a mitigation project. And you don't bill that $100,000 in a cash basis accounting until you actually receive the $100,000 45 days later. So let's say the project starts in February, but you're not going to get the cash in the bank until April, right? But you're doing the job in February. So on a cash basis accounting methodology, if you're doing the job in February, you're going to be spending money with your technicians going out to the job. You're going to be spending money on materials and such. Your P&L is essentially going to have zero income on that job, and you're going to have all these expenses. Let's just say $50,000 worth of expenses in that specific month. So if you take a snapshot in the month of February, you're going to run around with your hair on fire, and you're going to make some bad decisions on your business because apparently your business looks like it's lost $50,000. In reality, it hasn't lost $50,000. It's produced this revenue very well. But the problem is cash basis accounting won't tell you the story that the revenue is going to come into the future. Now, fast forward to April, cash basis accounting is going to break again. Because now in the month of April, we're going to have $100,000 coming in from Mrs. Jones. And we're not going to have any costs on that job during the month of April, at least cash basis costs. And then we're not going to have any expenses on that job during that month. So now in that month, we're looking like we just made $100,000 of net profit on that specific job. And you can notice that February, we literally want to pull our hair out because we thought that the business was absolute crap. And then in April, we wanted to run around and jump for joy because we thought the business had just hit the lottery. So cash basis accounting and restoration is always going to give us these highs and lows, and we don't want to do that. What we actually want to do is manage our business based on accrual basis accounting. And on accrual basis accounting, if we would take the same Mrs. Jones' job, in the month of February, when we're doing the work, we would recognize $100,000 of income, we would recognize $50,000 of costs, and we would show in that month that we actually generated $50,000 of accrual profit. Then in the month of April, we would have no transactions other than our accounts receivable balances going down and our cash balances going up. So it's a much more stable way to run the business from a management perspective. So other than cash and accrual basis accounting, the other mistake I see restoration contractors do is the way they invoice and recognize revenue. So I'm going to give a completely different example here, and I'm going to give you an example of a $750,000 reconstruction project with a $325,000 ACV payment. Very common. And at our restoration company, for example, we have the policy of going in and saying, hey, we're going to take the ACV as a full deposit up front before we start any work. So out of the $750,000, we'll have a $325,000 check coming in. And the mistake that most contractors do is that they'll invoice in the month that the check is coming in a down payment of $325,000. And in that case, in the month that you actually took in that money, you're essentially going to be overstated on revenue. And then every single month thereafter, you're going to have this period of time where you're going to have all these costs hit your books, but no revenue. So you're going to look like you're not profitable. And that's the problem if you don't deploy this thing called work in progress accounting. So the proper way to do it is to, yes, take the $345,000 of cash, but put it into a little piggy bank called unearned income. And we'll talk about that in a little bit. And then as you're actually completing the project every single week or every single month, you want to recognize revenue for the phases of the project. So if, for example, demolition was $10,000 worth of revenue because per the Xactimate line item invoice, the sum of the demolition line items were $10,000, I would recognize in that specific month $10,000 worth of revenue. And then my unearned income balance would go down from the $345,000 to the $335,000. And then every single month, I'm doing the same thing. As I'm producing work, I'm recognizing revenue in that specific month. The beautiful part is the costs are coming in onto my P&L, and everything is nice and balanced. And true accrual-based accounting should show you your revenue figure as what you actually produced, and all of your costs should be what you actually incurred. And everything stays in balance, and it tells this whole story of the business on an accrual basis. And then the other component that you would look at is something like a statement of cash flows to see what the cash component of the business is doing. So the proper way to deploy this strategy is to take an Xactimate estimate or a signed contract in Xactimate and divvy that estimate up into work orders. And those work orders, think of those as like tickets to actually submit to your subcontractors. If you've ever walked into like a Portillo's or a McDonald's line and you've ordered a big order at McDonald's, the printer actually sends out all these different tickets to all these different stations, right? So the fry station gets a ticket, the hamburger station gets a ticket, and so on and so forth. You want to do the same thing with your reconstruction jobs. So you take your Xactimate estimate and then you chop it up into separate work orders. At Albi, we actually have a tool called our workbook tool that integrates straight within Xactimate, pulls all their information out, and then you could divvy it out into these work orders. And then those work orders need to have an estimated revenue amount attached to each individual work order. So that's how much revenue of the whole project does that work order represent. So for example, demolition has $15,000 of this big project, and plumbing might have $20,000 of revenue, and carpet might have $25,000, and so on and so forth. And you split out these work orders, and as these work orders are completed, you're essentially invoicing the project and recognizing revenue. The problem with QuickBooks Online and QuickBooks Desktop is they actually don't have a work order object. So you're not able to sync your work orders or create any sort of work order within the system and be able to bill this way. So the hack that I've kind of created as bubblegum and duct tape for those of you guys doing, sub $8 million or, 8 to maybe $15 million of revenue, and you don't want to switch to an ERP yet, which we're going to talk about in a little bit. The hack that I created there is we would do a weekly production meeting where on every single project, the project managers will report back to finance how much percentage of revenue or how many work orders they completed. And then finance would actually create an invoice on that project for the work order amount. Now, that invoice wouldn't necessarily go to the customer. So remember I told you guys earlier in this video that when we took the $345,000 deposit at the beginning of the project, we put it into this account called unearned revenue. When the project manager says we completed $10,000 worth of demolition work, the accountant basically creates an invoice and gets it paid by that unearned revenue account. So it's kind of like an imaginary bank account that now that customer has. And they do that via what's called a journal entry. They keep doing that throughout the process until the unearned revenue account goes to zero and there's no more money in there, and that prompts us to go after the customer and ask them to give us another deposit. So the bubblegum and duct tape way to keep your books in line with QuickBooks and Sage is to have this weekly work in progress meeting for your reconstruction work that enables this line of communication between finance and your project managers, and have your project managers report back how many work orders were completed on that project. It should only be about one every 2 weeks or so, and tell finance how much they're going to bill on the project. Finance will bill it on the project, make sure the revenue is properly incurred, and then finance will move the money out of that imaginary prepaid account, that unearned revenue account via journal entries until it dries up. Now, this creates a perfect segue to start talking about what an ERP is, or an enterprise resource planning solution. So there's two big ones on the market. There's Sage and NetSuite, and at Albi we integrate with both of them. So Sage has a construction-specific ERP, which is basically an accounting system and a general ledger for contractors that very large construction companies use. And then NetSuite has the same thing. And the key differentiator is the fact that they have these work order objects. So you no longer have to necessarily hold these work in progress meetings between your project managers and finance together, because the data would flow from your job management system straight into the system in this format. And as work orders are being marked as completed, it would automatically recognize revenue within the Sage platform. Now, I'd recommend that when you're about $10 million a year or north of $10 million a year revenue, you should start considering. If you're over $20 million a year of revenue, you should absolutely look into a solution like this. The other caveat that I would bring in is if you have multiple entities. So if you start going multi-location and now you have multiple EINs and multiple sets of books, you're going to want an ERP like Sage or NetSuite, because QuickBooks can't handle multiple entities and multiple P&Ls. Now, a lot of people subscribe to Can-Am system, PSA's accounting system, and back in the day, that's what they were quote unquote well known for, as that's how they tried to position themselves. But if you'll start talking to people who actually use the systems, there's a lot of frustrations and the clunkiness that exists with having your accounting system need to be installed on a server in your back closet. And obviously, they're not as big as Sage or NetSuite, so they haven't had the resources to deploy to build a sophisticated enough accounting system. So if you're on that bandwagon, just go talk to some Sage and NetSuite users, and you'll see that the ability that you have with those systems are 10 to 15 times more than you would with a traditional PSA. Now, two quick misconceptions to debunk on Sage versus NetSuite. Number one is it's not built for restoration. There's no ERP built for restoration that actually functions and can do everything that you need. These are built for work-in-progress construction companies, and it fits the mold of what restoration is. You don't necessarily need that accounting system to be slightly different. Your job management system is going to be built for restoration and will cover the restoration-specific needs. Your GL or your ERP can be a Sage or NetSuite, despite the fact that they weren't necessarily built for restoration. The second challenge that everybody brings is it's hard to switch, and there's so many providers out there that actually make switching over very easy. When I would implement Sage or NetSuite, I would highly recommend hiring a consultant that specializes in this. They would create a white glove experience, move everybody over, and then train your entire accounting team on how to use the platforms. Typically, the person holding up the process is your CPA or your existing accounting people, as they're afraid that it's hard to switch. I've seen many companies switch off with no problems. So the last thing I want to get into is my recommended accounting stack and just what I think your accounting tech stack should look like if you're running a $10 to $15 million plus restoration company. So your GL or your general ledger or your ERP, as we talked about, I'd recommend Sage or NetSuite. They are best in class when it comes to handling the sophisticated things that we talked about at the beginning of this video. For spend control, I strongly recommend this product called Ramp. That's what we actually use at Albi, at the Restoration Mastermind, and even at Longview, our restoration company. And what Ramp allows you to do is create spend cards with cost control limits for every single employee. So that way you can empower your team to make transactions within your business, but you also have the cost control systems that you need in place. For payroll, I strongly recommend Gusto or ADP. Those are kind of two popular options. ADP would be more on the sophisticated side, but Gusto's actually revamped quite a bit in the past 5 years, and they've done a great job accommodating larger organizations. I would strongly not recommend systems like Rippling, for example. There's a lot of outages and a lot of frustrations I've heard a lot of people use. A lot of people get enticed by Rippling because of the open ecosystem, but just know you're paying with a lot of errors on tax withholding and so on and so forth. And then dashboards wise, if you're an Albi user, I would 100% recommend Albi Analytics. It integrates with your entire tech stack and it can give you a bird's eye view over everything that's going on within your business. If you are not an Albi customer, using something like Power BI or Domo would be a great tool to layer on top of your entire tech stack and be able to get the visibility. Now, a quick caveat, not to bash Dash in this session, but if you're using a closed-off tool such as Dash, you're going to have a hard time being able to integrate all the data together, so you might experience some frustrations there. Now, a quick shameless plug for Albi. Albi is the only job management system on the market that integrates with Sage and NetSuite, allowing your job management data to actually flow into ERPs such as Sage and NetSuite. So there's a little shameless plug there for us. So landing the plane here, if you're still scaling a business with cash basis mindset and QuickBooks, you're literally gambling. You're not running a business. You're literally gambling with one. But the good news is the fix is simple, and the payoff is clarity. Drop a comment below with your financial tech stack. And if you're over $10 million a year and you want to kind of talk through the pros and cons, feel free to drop me a message and I'll happily hop on a call and walk you through the pros and cons of all platforms and help you engineer and architect your financial tech stack that you're going to take your business to the next level on. And as always, hit that like button, hit the subscribe button, as we love pouring into the restoration industry. See you guys next week.